to poor vs. standard, and it's come to my attention that I probably didn't start at the very beginning of investing. So this is a video geared towards people who are new to investing, maybe don't know what to do, don't understand certain things. So this is here to help you out. And if that's not your thing, that's fine. If you want to watch it and make me look like a fool by correcting anything that I say, also fine. Not financial advice, but just things I've learned from my time in market and doing the things that I do. Uh, and with that, let's get into it. So, welcome to the world of investing. And your first question might be, what do I do? And my first question to you would be, well, that depends on how financially stable you are at the moment, how much you make, your budget, things like that. There's a lot of great videos out there as far as budgeting, how to create an Excel spreadsheet to budget. I'm not going to rehash that. Just go look for one of those videos and you'll figure that out real quick. But the very first thing you need to do is figure out where your money goes. You get a paycheck, write down everything you spend money on. That's first and foremost. You shouldn't be investing in anything unless you have no credit card debt. And I mean that, like no credit card debt, zero, zilch, nada. I'm not saying you can't use credit cards. I use my Discover card all the time, but I never carry a balance month to month. I pay it off so I can get my rewards. That's it. That's the only way to use a credit card. If you're carrying a balance month to month, pay it off immediately. You're going to have an interest rate of 30%. That means you're losing 30%. You're paying someone else 30%. So, best investment you can make, pay off your credit card. That'll make you money hand over fist because you won't be losing it to someone else. The second best investment you can make is in yourself, and that is educating yourself. And if you're here, maybe you're taking that first step and putting your toe in the water to see what's out there. Uh, as far as educations and things, that might be useful to you, find something you enjoy doing, figure out how to make money off of it. It's a great way to make money. But as far as markets go, that kind of thing's concerned, that's what I'm going to talk about here. So that, I mean, it's it's kind of interesting, right? Over half of Americans can't afford $1,000 emergency. Like if axle breaks on your car or something, and the repair shop's like it's gonna be $1,000. People are gonna be putting that on a credit card if they can. They don't have $1,000 laying around. So first and foremost, get yourself $1,000 that you're not gonna put into any market that you have on hand in case something happens. Every time. Without fail, things rarely go as planned, so something's going to come up. It's going to cost you money. Get yourself a little bit of cash on the side so that you have a rainy day fund for things that may go wrong. Now, you don't have credit card debt, you got yourself $1,000, you've got a budget, you've got a little bit of extra money laying around. What do you want to do with it? Well, if you just want a passive, not worry about it kind of deal, I mean that's great. The S&P 500, definitely the way to go. It doubles every 7 years, almost without fail. And over the course of 15 to 20 years, it's essentially not any type of risk. I think it's something like 99.8% profitable after 20 years in the market, if, as long as you have good companies, or the S&P 500, which is an ETF, which is an exchange traded fund. It is basically uh, a company put 500 different companies together, squished all their stocks together, bought pieces of each company, and they put that up and said, you can buy a share of this and you'll have exposure to all 500 of these companies. And on average, since its inception, it's doubled about every 7 years. So if you had $100 in it, in 7 years, you'd have $200. Not guaranteed, but pretty close. So if that's, what you want to do, I would suggest, and I'm saying everyone should do some exposure to the S&P 500, broad market funds, that kind of thing, because they've done a lot of studies about people trying to beat the market And one of my more fun stories is the fact that they had the top hedge fund managers pick stocks for a year, and then they had a cat basically walk on a piece of paper and pick stocks, whatever the cat picked based on where it walked or whatever. And the cat outperformed all of the large hedge fund managers without fail. So that goes to show you, that's one of those anecdotes where it's like random chance happens. So it's better to just have yourself a bucket of good companies that has a track record that's proven. Everyone's trying to beat the S&P 500. So if you have the S&P 500 as part of your portfolio, that's you're not going to lose money to, investing in worse companies or into some charlatan trying to sell you something. So I would suggest always having a piece of the S&P 500 in your portfolio. And depending on your age, depends on how much, and your risk tolerance depends on how much, and the time you're willing to spend, researching companies and investing. So very basic, very easy. If you don't want to do anything, just toss all your money in the S&P 500. You'll be fine, more or less. Again, no guarantees, not financial advice, but track record would show S&P 500 is the way to go for beginners. As far as figuring out what stocks you might want to pick or things of that nature, you're going to need to research a company before you put any money into it. Like you're going to hear all these people online, yell Tesla or Plant Palantir, just all these really huge growth companies that have seen spurts of growth that are massive. Like when Tesla shot up to like $300, $400, $1,200, had a three-way split, all these things. They're just like, it's never going to go down. And that's not true. Everything eventually does come down one way or another. Um, and it's that's why the S&P 500 is so nice is because they rebalance it every year. You don't have to do anything. So companies that no longer meet their criteria get ousted, and companies that meet the criteria get put in. So it's a reshuffling and a rebalancing, and it just keeps going up. Whereas you pick a singular company, such as Tesla, when it was at like $900 and then it dipped down to 500. If you bought at 900, you were kind of boned. Now, Tesla's a very interesting case study because it's still ongoing and it does a lot of things that people don't realize it does. It's not just a car company, it's also robotics, energy, and a battery company. There's a lot of things going on with Tesla, but that's not what we're here to talk about. Essentially, if you're just picking a stock, you need to know its profit margins. You need to know what product or thing, or you need to know everything about what they're selling, whether that's a service or a good. And then you need to know who their competitors are. You need to know how long they've been profitable, if there's any dividends or anything like that. These are basic things that you want to learn about a company before you invest in it, which is why you shouldn't own more than 5 to 7 companies because you have to continuously check up on these companies, make sure that their profits are good. Once a quarter, you're going to be looking at a quarterly report, and that's above and beyond. You're just talking basic, what do I do? I'm investing. I have a little extra money set aside. What am I going to do? If it's all you really need to do is the S&P 500, if that's, where you're going to start out. And the ticker for that is SPY. Um, and so if you were to find something, if you get on a brokerage, and I recommend for newbies, I do recommend Robinhood because it's very simple to use. And I'm not sponsored in any way, shape, or form by them. But if I was a new person starting all over and didn't know anything, I find Robinhood is very easily accessible for people. So signing up with Robinhood is probably your best bet if you have absolutely nothing about stocks. Um, yeah. And so with that, there's a lot of tutorials and lessons that they have right on there. I mean, if we were to go take a look, if you take a look, we're on the SPY, S&P 500 ETF, exchange traded fund. And basically, this is a chart you will always find, whether it's a day, a week, month, 3 months, year to date, which means from January 1st of this year forward. 1 year, 5 year, or time. So if you look at the maximum, you can see right here, we're roughly 2000 is as far back as it'll go. Uh, and then if we go to 2007, like we said, it didn't double because you have kind of a crash thing happening. But yeah, that's 2007, so 146, 150. If you remember 2007, 2008, the housing market crash kind of dips, so that's where that is. But if you go 2008, 2009, 73 bucks. So 7 plus 9 is 16. So 2016, where are you? There you are. 193. That's definitely a double between those two. From 93 to 193 or 97 to 193. Definitely a double up. And then 16 plus 7 would be this year. So from 200 to 400, I mean, yeah, that's a double again. So it does pretty much every 7 years, give or take, it will double. And that's the part you're going to find every time you go to Robinhood, and you can basically buy, right? Just click buy, and then how much you want to buy, you order, and it even tells you how much money you have in your account to buy with, and just that's all you need to know. And you can do that. You can look up any stock you want. So let's say you wanted to look up, and they have all these screeners for you. So like things that just hit a new 52-week high. Pretty cool. So you can see these things getting pretty crazy. Just and you can screen however you want. You can, I mean, they have custom screeners. They have new 52-week lows, high volume, all sorts of different screeners. But if you just and then this little feather in the left will take you to your home page. Then you can see anything you've bought is up here. Like we have a cryptocurrency, we have Palantir stock, we have SPY, and we have SCHD in this account. And this is your buying power. You can always deposit more funds, and you can see, the same thing here. Basically, this is the last week. It went down. The last month, also down. You're going to see a pattern here because we've just started this in July. Over the course of a couple months, you're not going to have super awesome results, but over the course of years, long-term investing is the way to go. Yeah, see, we started in July, like July 17th, 18th, somewhere in there. So that's what we've put in. And yeah, that's the basics of what you need to know. So do your research on your stocks that you want to invest in, leave it in there, and honestly, there's other things you can do aside from stocks. There's literally places you can put money in where it will give you 4.5%. It just land in a bank account somewhere. Always a good option. Lots of things like that. And if you have any questions, feel free to leave them in the comments because that's what I'm here to do. I'm here to help and answer any questions I can. So I hope this was kind of instructive, some type of, tutorials and helpful. And just be safe with your money, be careful with your money, and don't believe people that say things like, "Oh yeah, I have a get rich quick scheme," or "This stock is going to moon," and all that kind of language is there just to trap you. And be very careful about that. And the things that you read, make sure they are good sources with good track records, because and even sometimes, I mean, news media just will say things like, "Oh no, we're going to have this massive financial crisis." Even if we have a massive financial crisis in the next year or two, as long as you don't sell at the bottom, if you just hold your investments and they're good investments, you should be fine. Just remember, don't panic. Yeah, like we've put $1,100 in this account, we're down over 50 bucks. Not a concern. Like, yeah, we're down 5%, 55 bucks. That sucks, but that's okay because we're buying these things $5 a day at a lower and lower price. So we're dollar cost averaging, which if you don't know what that is, Basically, you average your cost because we started buying, let's say we started buying Palantir when it was $17. It's now $14. We're still buying it every day, and we're buying $5 a day at $14. Even though we started buying at $17, so our price per share is getting lower because you average the cost. So let's say we bought 5 days worth at 17 and we've bought 10 days worth at 14. You're going to be closer to 14 than 17 if you've been buying the same amount every day. Does it make sense? I hope it makes sense. You basically add them all up and divide by the number of days. And that's your dollar cost average, your average cost of a share over the course of the time you bought it. So I know this was kind of sporadic and jumping around a little bit, but hopefully you got something out of it. And if you have any questions, feel free to leave them, drop a comment below, like, subscribe, and always happy to help. Have a good day.